I want to thank everybody for joining us this morning. We'll go ahead and get started. What we're talking about today is continuing our In the Trenches series, which deals with operational compliance concerns during the COVID-19 crisis. As we are working through our program today, what we're focusing on is how you actually go live and implement the PPP program at your bank or credit union or financial institution, non-bank lender. What we have found is that a lot of our clients are coming to us and asking about how they can actually deploy PPP loan signing, how they can obtain applications, how they're able to collect this information so that they can efficiently bring their customers or potentially new customers through the PPP process. And then on the back end, actually issue documents and preserve them in an enforceable way so that we're not exposed to potential claims or loss of guarantees on the back end of this. And so we're really going to start with kind of a two-step process, if you will. The first part will deal specifically with some of the ESign obligations that you have when you're taking electronic applications or then signing documents electronically. And then we're going to talk specifically about PPP underwriting, how you can collect that information, what information based on the latest guidance that has come out you need to be collecting, and then how you can deploy those files. And then we'll briefly talk about the risk analysis framework. You have on the phone today, this is Brad Rustin, financial regulatory attorney with Nelson Mullins. One of my good friends and colleagues, Craig Nazzaro, is also on the line, and so we'll be team presenting this morning about these issues. Both of us went through the financial crisis, helping banks and financial institutions with the response to that. And then later on, issues regarding the compliance backlash that came from regulators with some of the sloppy work that was done during the recession, as well as issues regarding enforceability. And so you'll be hearing from both of us. I'll be handling generally the first part on e-sign and e-closings, and then Craig will be talking about the PPP underwriting process in particular. Let's start with kind of some basics of e-sign, and we'll move through these very quickly. But what I want you to remember is when we talk about electronically signing documents, there's in essence a multi-step process. It's not as simple as simply having someone sign an electronic agreement. We've got to think through how we're going to provide electronic disclosures, how we're going to take e-delivery of underwriting materials and applications from our customers, then how we're going to do the e-signing and e-closing, and perhaps the most overlooked but possibly most important, how are we going to archive and retain these records after we originate the individual loan agreements. Two general laws apply to electronic signing. One is a federal law, the ESign Act, that everybody knows about. The other is state requirements under what's called UETA, the Uniform Electronic Transactions Act. Both of those carry particular requirements that you must satisfy in order to have a valid and enforceable electronic document. And so we'll talk a little bit about those and how they can impact you as you work through the PPP process. When we think about e-sign, I want you to remember that it's about two basic concepts. How do we attribute it to somebody, and is it legally sufficient? We'll talk in a second about this concept of authentication and authorization. Anytime you're doing, whether you're taking telephone applications, whether you're taking electronic applications, anytime you're not sitting face to face and having your customer give a wet ink signature, you need to be thinking about this issue of authentication and authorization. How do we know that this person is who they are? And then how do we know that it's their signature? UETA and eSign are very specific in that all they say is an electronic signal counts the same as a signature. It doesn't talk about proving someone was who they were. It doesn't talk about how you prove that was the document they saw or signed. It just simply says legally courts cannot refuse to enforce an electronic document. Remember, it's all in the proof. How are you going to prove that's what they signed? That's the person who did the signing, and this is the document that they saw. The key to enforceability picks up those two aspects: attribution, who are they, and then the integrity of the record on the back end. When we talk about disclosures, that layers on top of eSign. eSign only talks about the actual signing of the application, the signing of the loan agreement. You need to make sure that if you're planning on giving disclosures, to those individual customers, you have an e-disclosure agreement in place. That's in addition to your ESign agreement. So as you're building your PPP program, make sure you're thinking through how are we going to make sure Brad Rustin is who he says he is, and how are we going to make sure that when we send a document electronically to Brad Rustin, whether that's by email, through a portal like DocuSign, or even if we fax it or send it some other way, how do we make sure that he received it if it's a document that we're legally required to provide to him? And so, start with this concept. How are we going to deliver and provide those disclosures? Then on top of that, we'll deal with how are you going to electronically sign and execute those documents. Remember, this only applies if you're going to use electronic or non-face-to-face means to provide your disclosures. We've talked to some banks. They're going to be sending paper copies to their customers. Obviously, if you're sending paper copies, as long as you comply with the timing requirements, no issue with then having to have enforceable electronic disclosures or e-deliveries. Remember, with commercial customers, you're not specifically subject to the FDIC, OCC, and Federal Reserve and NCUA guidance regarding e-sign for consumers. So you're not required to do test emails. You're not required to do, comply with those other consumer guidance obligations. But you are required to comply with ESign and UEDA, its basic concept of authorization and authentication. How do we know who it is? How do we know that that's what they signed and that they intended to sign it? I will say, for those of you who have been working on electronic presentations of documents or electronic signing of consumer documents, the consumer obligations layer on top of the basic requirements. So if you've been working in a consumer space, you do consumer loan closings, that will also apply and then be enforceable in the commercial context. But just so you know, should it come up later, the requirements inside of the FDIC and the other regulatory guidances are just applicable to consumer obligations, not commercial obligations. Commercials are governed instead by basic ESign and UEDA. When we talk about those consumer disclosures, we've provided them here for your reference should you want to use this in the future. But remember, with the consumer, the important part is they have to electronically consent or provide demonstration that they can receive electronic disclosures. That does not apply in the commercial context. Instead, it's an issue of proof. You have to prove that the person who signed it was in fact who they said they were. That's the FDIC guidance in case anyone should need it for future reference. We provide in the presentation more just so that you have it for future use. Remember, when we talk about ESign, what we're doing is creating an electronic record. And ESign says we're not going to make it any different than a paper record. If it's something you could sign in wet ink, then it can also be signed electronically. It doesn't relax the requirements. It doesn't increase the requirements. The real challenge is if it's an electronic record, it's got to be maintained in a form capable of being retrieved by the parties. This is one of the things we'll focus on in a few minutes, but it's one of the big pitfalls that we're seeing as people are designing their PPP programs. How are you going to maintain all of your records regarding how you determined that Brad Rustin was who you're dealing with? How do you determine that it was Brad who was sitting at his computer when they electronically signed these documents? How do you know it was Brad who was speaking to you on the phone when he provided his application to you if you're doing telephone applications? Remember, the challenge with eSign is authentication. How do we know that you are who you say you are? Many different ways. There's guidance from all the prudential regulators regarding authentication in an electronic environment. That's a really weird title, but that's how they refer to it. And there's different ways. It can be something as simple as using existing logins to online banking, what's called shared private keys. We have some banks that are going to go out to their customers and say, here is a password that you're going to use. We're going to give it to you by phone after we authenticate you. We're going to ask you questions about your account, questions about your banking relationship, and then we're going to give you passwords. That's what's called a private key, something that we gave to the customer so that he or she can come back to the financial institution to prove they are who they are. what's called public certificates. Some of our commercial customers may be sophisticated enough, they have what are called public certificates, which are ways you can authenticate yourself using existing electronic signing platforms. Uh, Technically, ESign, you can have something as simple as email confirmations. There's a whole series of cases where you can send an email, they scan the document, send it back to you. And as long as you can prove that email is from them, such as by talking about something that only that person would know, or some other proof that that's the person who you believe it is, then that can be enforceable as well. In essence, it doesn't change any of the rules. Anything can act as an electronic signature. The challenge is always, how are we going to authenticate you? And then finally, what a lot of our banks, credit unions, and lenders are deploying is going to be third-party services, which is using folks like Ideology, Trulioo, Experian, Jumio, integrations that exist already into DocuSign, Fiserv, and FIS, and Jack Henry that do non-face-to-face authentication. And this is generally what we refer to as out-of-wallet questions, or OOW, meaning they're going to ask challenge questions about where you lived, past accounts, things that are available that would not generally be available to someone who was trying to steal your identity. And so most of the major core providers that we've been working with on their PPP deployments have built some mechanism for the ability to do non-face-to-face authentication. Obviously, those top ones help when you have an existing customer relationship, which a lot of our folks are doing right now, keeping only to their existing customer base. It makes this authentication a lot smoother. There's ways we can do workarounds with you for that. But when you start making PPP loans to non-customers, this becomes absolutely critical. How do you know that Jill Smith or Jim Smith is in fact who he or she says they are? How are you going to authenticate them? And that's where we turn to those third-party services that can do that authentication. When we say authorization, the second half of ESign, this is actually the easiest part, which is you must clearly tell the person that if they do something, it will be treated as their electronic signature. It can be, click the box. Some like DocuSign, if you're on a tablet, you can actually write your signature with your finger. All sorts of different ways. If you're on the phone, it can be saying simply, I agree, or saying, yes, that sounds right. It can be anything that demonstrates that they agreed to what was just stated, or that they intend to sign the document. The key is making it absolutely clear. We see this happen a lot with our banks and credit unions, which is, you have a whole list of things you say by, clicking below, you agree to this, 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 this. One of our best practices we always advise is not necessarily making sure you display each of those agreements, but make it clear what those agreements are in a non-deceptive way. Meaning, if it's a credit authorization, make sure it's clear that's a credit authorization. If it's going to be signing of a loan document, make sure that it's clear that when they click the box, they're going to sign it. If it's electronically agreeing to their application they provided by phone, make sure you clearly tell them that if you do this, you will be submitting this application electronically and you'll be signing the certification. It's all about clarity, and obviously don't try to be tricky and say, if you say any word after this, then you're agreeing to this. That's normally not the issue. Instead, it's making sure it's clear what it is they're agreeing to. Be careful of what we call cliquewraps. It comes from the shrink wrap, which everybody used to do with software, which is if you open the box, you've agreed to these terms. We generally try to discourage folks from simply running down a list of items and saying, anytime you do this, you're agreeing to these following agreements. We try to avoid that. Instead, make sure you're calling those out individually. Most of the software solution providers that people are using for PPP do a very good job with this, and are either going to present the document or actually have each document separate, and then the person is going to click saying they have read and understand and agree to it. Finally, you get to what's called the signing ceremony. Again, authentication is the key. Only make sure the person is able to sign and agree to documents after you have done that authentication. If you're going to take an application by phone, make sure that they understand that they are providing a legally enforceable document, and tell them that they are going to be doing that. And if you're going to authenticate them, which you need to do so that you know that, Susie, who is making the application, is in fact Susie, you need to document the steps that you went through in order to authenticate Susie. Now, best practices would be to have a form or worksheet that your banker goes through in order to do that. Certainly, secondarily, and Craig will talk about this a little bit in the second half, if you don't do that, make sure you at least have a very thought out policy and procedure so that later if Susie says, I'm not the one who was talking to you on the phone, you have some way of saying, here's our policy and procedure for determining that. In order for us to take the application, you had to have passed these tests. And then obviously make clear, especially if you're doing it by phone, it's a little bit easier when you're doing it by electronic presentation, that when they say, I agree or I wish to submit this application, that's going to have the legal impact of they are signing and submitting that documentation to you. When we talk about the risks associated with ESign, remember there's 5 risks, and this comes directly from prudential regulatory guidance. The biggest risk you have is authentication. 6 months from now, somebody saying, I didn't give you that, that's not my signature, I didn't sign that, I didn't agree to guarantee that loan. Or I don't know who submitted that application to you. I don't know who submitted that certification of the number of employees I had. I don't know who submitted that tax information to you. Then you have what's called repudiation risk. Somebody says, yep, that was me, I was talking to you, but that's not the document that I saw and signed. That's not the document that I sent into your portal or I emailed to your banker. Then obviously you have the compliance, adoption, and relative risk, meaning how does it compare to doing it by paper. Interestingly, the relative risk of doing ESign is actually somewhat smaller or lower than doing paper documentation. A lot of people are very good about keeping documentation, but with ESign, there's actually a documented audit trail of how we determined that that was in fact little Jimmy or little Susie who was submitting it and signing that document. Here is kind of a framework that you can reference in the future regarding how you deal with these different risks. It's really kind of designed for a compliance staff. But remember, the key here is to follow each step of that process, which is authenticate them, authorize it, save, and retain it. We use DocuSign here as an example because this, second only to authentication, meaning somebody saying that's not what I signed or that wasn't me, this is the biggest challenge with ESign. How are you going to keep an audit trail to know that's who actually signed this document? Here's how we know. And so I use the DocuSign matrix. The standard is create use of an email address and then using some multi-factor add-on, meaning DocuSign is going to send the document to little Jimmy or little Susie at his or her email address, and then the banker is going to have to share an access code for that individual to then use to log in to electronically sign that document. As you can imagine, then that's only as good as the banker's access code and the record the banker keeps as to how he or she sent the access code to little Jimmy or little Susie. For those who are going to be doing non-existing customers, meaning new customer PPP loans, you can then use some of the more elaborate, such as third-party identity checks or knowledge-based authentication, meaning we're going to integrate with Trulioo, we're going to integrate with Ideology, we're going to integrate with some of the other document or identity certification services to do that authentication. Probably the easiest for existing customers is to either use the shared access code or to use SMS, meaning the bank sends a message using the cell phone number of the customer, and then the bank or credit union requires that customer to then use that cell phone to then log in to DocuSign to do the electronic signing. There's also a way to do that by phone where they actually call and give you a code you put in. Some of you guys may be familiar with that. Social ID and digital certs are only really good when you have extremely sophisticated commercial clients for digital certifications where they have digital certificates in place. Social ID is something DocuSign offers, but in essence, it's using things like Facebook to authenticate a person. That's only as good as the underlying information, so we generally advise folks to stay away from the social ID. Authentication. Remember, the interesting thing is with DocuSign, it may actually be more enforceable than a regular signature. If you think about a paper record on the left, it's just a signature and a date. With DocuSign, we actually say, here is who signed it, here is the IP address they used, here's when, and here's how we did the proof of that person's identification. So, again, make sure we're keeping this, and we're going to put all of this in what's called a tamper-proof container, meaning the bank's not evil and changed the document after Jimmy or Susie signed it. We have to keep it in what's called a forensically secure format so that we can then, if this person challenges their signature, go back and prove it. Now, most of the e-signing services will keep those documents for some period of time for you. If you do print them off, and that's going to be your retention, be aware there's some issues associated with that, mainly that you need to have a policy and procedure for who printed it, what they obtained when they printed it, how it was maintained, and then if you're going to maintain that as part of your central corporate records and your document management system, it needs to be maintained in a way that you can track who accessed it, and in the event somebody disputes it, prove that it wasn't changed from that original. Most of the big electronic signing services have their own vaulting service where they can maintain it for some period of time, and some even have a repository or a true e-vault where they will then maintain it. Just know that once it's signed, there is one final step, which is keeping it in that, quote, forensically secure format so that you can produce in the future. And the court's going to ask, how do you know this is what they saw? How do you know that they were the signer? And how do you know it hasn't been changed since that date? And that's why we talk about those tamper-proof containers or those forensically secure repositories. The key to that is that audit trail. Make sure that you have the printouts from your electronic signing engine so that you know how you authenticated, what you used, when they signed in, and then make sure you're keeping that in some form of a vault. Make sure your retention system is forensically secure so that somebody in your bank can later on go back and defend what it is that that person saw, what it is that that person signed. And then finally, remember that when we're talking about forms, be careful about how those forms translate into an electronic environment. Make sure you're testing these on a regular basis because we have seen a lot of issues where things don't display properly. You load something up in a DocuSign container, you put it on a web form, and you're missing key disclosures. It's one of the simplest things, but it's often a speed bump that a lot of our clients hit, which is they don't test the online presentation and make sure it's in an appropriate format where everybody can read it. When we talk about what can be e-signed, in essence, anything can be e-signed unless it's subject to certain restrictions in the Uniform Commercial Code, mainly negotiable instruments under Article 3, bank deposit agreements and collection agreements, and then secure transactions under Article 9, meaning security agreements. That's all well and good, but remember Article 3 and Article 9, so negotiable instruments, promissory notes, loan documents that are transferable, and then secured transactions, Article 9, security agreements, each have a savings clause that say, we will recognize electronically signed documents for purposes of these requirements. So you can electronically sign a security agreement, you can electronically sign a transferable promissory note, but it's technically under those UCC provisions, not expressly under the ESign Act or the UETA, Uniform Electronic Transactions Act requirements. Huge caveat here. Real property documents generally cannot be e-signed except in a limited number of states. So don't try to do, recordable mortgage modifications, deeds, other transactions affecting real property. You want to be really careful with those because it is a state-by-state analysis. About 8 states now have some version of that, but in general, the states do not accept real property records e-signed. Last kind of caveat, and then we'll shift to Craig's discussion specifically in relation to PPP, is remember ESign doesn't change any other substantive requirements of law. We're in South Carolina at the moment. If you're in South Carolina, certain arbitration agreement requirements have to be in bold, all capped, underlined. That doesn't change if it's electronically presented. Again, it goes back to really watch your quality assurance in your first line associated with electronically signed documents, because similarly, those same requirements apply. Same thing with timing. If you have to provide a regulated disclosure to someone, you're going to do a home equity line modification, and there's certain notices that have to go out on certain timelines. ESign doesn't change those. Again, good enforceable electronic or consent to electronic disclosures. Finally, some people have asked us questions about e-notarization. Only 3 states had fully done e-notarization. A number of states recently have passed through their Supreme Courts or through special executive orders and e-notarization process. If you run into that, just be aware that is still extremely cutting edge and is very specific requirements regarding what the notary sees, how he or she is able to confirm the identity of the person. And so if you're going to go down the path of trying to get electronically notarized documents, make sure you're talking to your legal counsel, make sure you're talking to your compliance folks, because it's not very widely accepted generally. A lot of states have put in the stopgap measure, but if you're going to do it, there's a whole series of requirements. And just like when you do a closing instruction package for a mortgage, you're going to want to have a closing instruction package for the notary so that he or she exactly follows your procedure about how you're going to notarize documents in an electronic format. Last thing I'll leave you with is just remember with an e-contract, e-contracts are nothing special. They are given the same impact as a written contract. All ESign, UETA, and then the provisions of the Uniform Commercial Code say is it is given the same legal effect. It's not something that is treated separately or differently. And therefore, all of your other requirements apply, but you can do it in a non-face-to-face, non-wet ink environment. All right, Craig, I'll turn it over to you now.
Thanks, Brad. So we wanted to discuss, now that we touched on the electronic signatures and electronic execution of any documents that might be related to the PPP loan program, we wanted to go over the regulatory compliance issues or challenges that you might see as the programs begin to roll out. First, just the document gathering and what should be associated with the loan, what you're going to find in every file. We just want to outline them for you, which forms are currently being recommended for use. The lender application form, borrower application form, they're all right here for you. It's here just to go through. The consents are in there as well for what Brad was discussing on how, if you're going to electronically sign these, what needs to be put in front of the borrower in order to say that they were aware that that's how the loans are being executed. Brad, if you want to go to the next slide. This is the underwriting collateral and collateral file checklist. So on the left-hand side of the paper here, I outlined what Section 120, 150 of the SBA has for underwriting guidance. If you were traditionally underwriting an SBA loan for creditworthiness, risks associated with the application, it's what you would be looking for. As we saw when the CARES Act came out and the interim final rule, we're not being held to those standards. We no longer have to look at that or consider it a risk-based loan. We're basically looking at these as the underwriting as metric checks. You're going to look to see what's on the right as to how to evidence the loan. The evidence of number of employees as of February 15th. How are you going to do that? You're going to do payroll records, filings, Form 1099. The evidence of monthly payroll costs, 941s, 940s, W-2s. One thing I do want to say about this that came out in the FAQs overnight, banks were asking that, what is our responsibility around confirming the dollar amount of average monthly payroll costs of the preceding calendar year? How much do we have to review what the borrower submitted? Or are we like traditionally underwriting where we're verifying what the borrower is submitting for their payroll costs? We got back that no, you're not. providing an accurate calculation of the payroll cost is going to fall on the borrower. You're relying on that borrower certification, but the regulators are going to be looking for you to perform a good faith review in what they're saying is a reasonable time, using what the borrower's calculations and what they submitted. They advise that the level of diligence from the lender should be informed by the quality of the supporting documents. So if you're getting an ADP payroll, you can rely on that more heavily than if you're getting, their sole proprietor accountant that's sending you like what his belief of the payroll is. You're gonna have to look into that more closely. And if you do identify errors in the borrower's calculation of their payroll, you're gonna have to push back and kind of confirm it, just to help the borrower get to the proper loan amount. That came out overnight. Also, along with that is the NAICS codes, the OFAC search confirmations, W-9s, wire and ACH instructions, how you would pay for this file once it's determined that the borrower is in fact eligible and you do want to fund it. Brad, if you want to go to the next slide. So your compliance management system, your CMS. You have an existing CMS within your bank. How is this going to interact with the PPP product as it rolls out? During the last national rollout of loss mitigation in 2010-11, when we saw HAMP and HARP come onto the scene, a lot of banks initially started to roll those out in vacuums. Everything was siloed, and the bank's CMS policies weren't fully applied to the loss mid options as they were going out. You don't necessarily see this from the regulators or the government in the throes of trying to fix the issues that we're being presented with, but you will start to see them come back in 12 to 24 months when the regulators are in your offices looking at these loans as a look back. You'll start to get questions as, here's your CMS, how come this wasn't applied to this procedure? So you just want to be cognizant of the fact that you do have existing policies and procedures. Those are going to be applicable to this PPP loan program as it rolls out, and you're going to be held to the standards of your CMS. Three of the ones that I'm calling out here are the Fair Lending Program. You're going to have to apply that to, if you're going to market this, we'll talk about that a little later, the processing the applications. Your BSA AML programs are specifically mentioned within the CARES Act and the interim final rule as being applicable. And your Reg O policy is also one that's going to be applicable. The CMS also, you'll start to see there's going to be QA, QC functions, monitoring and testing functions, complaint program functions. Are you applying that to your rollout of this program? Are you having your CMS, react to the shift in focus to the PPP program as you roll it out? You're going to want to just document your responses to those questions and as you contemplate them. So when the regulators come in 2021, you have the base of a narrative around how you were protecting any customer risk that was out there or risk to the bank itself. Right, if you want to go to the next slide. So onboarding new customers. Your BSA and AML programs, as I mentioned, are going to be applicable. So at a minimum, you're going to require name, date of birth, address, identification number. So these are all U.S. persons, actually. So you're going to need a TIN number or an EIN. But what you have to remember here is your program controls. So you can't have the bare minimum just to do this quickly and get it through with the least amount of overhead, least amount of cost, trying to minimize the processing time. If you have a fairly robust BSA AML program, good for you, but you now have to apply that BSA program to these loans as they roll out. So you're going to have to look to your program to see, if you're going to require any EDD, what your KYC or CIP issues are going to be. All that's going to have to be applied to any new customer that comes on board. Brad, do you have anything to add to that for BSA?
No, the one challenge obviously is if you're onboarding new customers as part of this, you're in essence going to have to look to third-party sources of data, whether that's using information such as information from the credit report and doing it by hand, or alternatively, if you're going to be using some of these third-party engines, that's going to be one of the biggest challenges. How are you going to collect that? Because we run into the challenge all the time of it's not something where an individual can just simply send in their driver's license number or send in their passport number, for a U.S. passport or something like that. Instead, this truly has to be a way that creates a defensible record of the customer due diligence that you conduct. And so if you're going to try to do this in an online environment, in essence, you're going to have to start looking to those third-party providers. And a lot of those already have existing integrations with the big core providers. And so, obviously we work with all three of them, and they all have certain third-party systems that they can turn on. And so that's something to explore with your core providers if it's something you're going to do on a go-forward basis. That's not to say it's not just as critical for existing customers, but it's a particular challenge, and why we believe in a lot of circumstances, banks right now and credit unions and lenders are just opening this up to their existing customer base, because we're still working through how we're going to do the online CDD in a non-face-to-face environment.
And I do want to bring up the idea of your program controls here is something that you should be, from the regulatory and compliance perspective, your program controls is something that you should be repeating to yourself as you think about how you're going to document this process. I know it's a big rush to get the program out there, up and running, and start taking the applications in and processing them. But this is the first time you're going to see, like, your BSA program, for example, is going to control what you have to do for new customer requirements, and it's referred to in the Act. So it's going to be imperative that you start to create a program, a set of policies and procedures to govern the rollout of this PPP product. You're going to have to integrate the controls. First, we're seeing it here in your BSA program, but how are you doing that? If it's a new customer requirement, can you cite to your BSA program here and say, this is what we're asking of all new applicants? The process is being pushed out so quickly. It was given to the banks, within 2 weeks, you're standing up a brand new product rollout, which is something like, if it was normal day-to-day operations, this would go through multiple iterations of committees just to make sure everyone's weighing in. You do not want to forget that if something is missed here, like if you didn't take in a piece of application, and a regulator is looking at this in 2021, you're going to want to at least show, hey, it's missing, but we did have a procedure set that it would be collected. We were thinking about this when we rolled it out. It was just a procedural error or a processing error, but we did have a control here to think about this. Lacking that procedure to govern these loans, these PPP loans, you could be getting called out, or could exacerbate a problem that shows up in another exam. Like, say you have a BSA exam, and that they're calling out an error or two than your normal population of loans. If they start to pick up these loans in a review, you don't want to be caught with in a position where you don't have a procedure that governs that, and it just increases the severity of a finding that normally would be dealt with an MRA, or just a finding in an exam. It could increase the severity if the program and procedures are not there to govern this process. Brad, if we can go to the next slide. So existing customers. We did get guidance here that says PPP loans for existing customers will not require re-verification under applicable BSA requirements unless otherwise indicated in your own program. So again, here they're introducing the idea that you're to look towards your own institution's program. Don't rely on the CARES Act or the interim final rule to govern the procedures of this rollout. But what we don't want to see here are clients that are taking this literally for existing customers. They don't require re-verification. You still should have a process in here that's looking at the beneficial ownership mix, for example. You could have an entity that's applied, that's been an existing customer for years, and now the beneficial ownership proportions have changed. So there's a new owner in there. You're going to have to run him as if he's a new customer. You can't just not require re-verification if there's a new beneficial owner in there. Yeah, that second bullet point is what I was talking about there. Next slide, Brad. Retention of records. So again, the idea of your existing policies and procedures will apply. How are you, what is your record retention policy? Make sure you apply it to this set of population loans. And this is not because we're expecting there to be issues like around record retention, or they're particularly focused on it. It's just going back to see, what we saw coming out of 2008, 9, 10, and 11, what they start to focus on, and what we start to get asked questions in future exams. So you kind of want to start protecting yourself around that now. Also, for record retention, start thinking about how are you processing these applications? How are you retaining the documents? Are you verbally taking in applications? Are you doing electronic signatures? Is it all through an online portal that everything's being disseminated? So again, here, procedures.
And one of the things you mentioned, Craig, yesterday that I think is a good point, which is we expect a lot of documents to be coming in through different channels. It may be that a certain customer is providing their documents to a portal, but then they also email their banker or CSR and say, hey, here's some additional supporting documents. Maybe that comes in by email. Then the banker calls up and speaks to them by phone and confirms some information. How are we going to make sure all of those records are kept and documented? And Craig's getting ready to talk about, kind of looking back to the last decade, but this is what both he and I saw as one of the biggest compliance risks is when those became an issue. How did you get that document? Where did it come from? All of that was particularly challenging then 6 months later, 3 months later, a year later, when either we were trying to enforce guarantees or we were trying to enforce against the borrower. So just wanted to throw that in that you mentioned that yesterday, Craig. Great point.
Yep. So as Brad's indicating there, so like a decade ago when we were looking at HAMP and HARP and that rolling out, you're faced with the challenge of, look, how do we get this massive product or massive assistance to our loan population, all our customers? You might have the challenge of, you're not staffed for this. The departments are not built for it. You're kind of reorganizing it and trying to adapt as best you can, and you're trying to do it quickly. So part of the problems that you saw a decade ago rolling out would be, if you're verbally taking the application, say for HAMP and HARP, we saw a ton of regulatory complaints around borrowers claiming that they were being told to default. Every phone call, and this is just the employees at lenders were just trying to help the consumers and trying to help the customers of the bank by looking at the fastest way to get through it. But by doing that, they were enabled to, speak outside of what would be in a procedure because there was none implemented there. And then as borrowers would just allege that, for example, the regulators would ask you, well, how do you know that didn't occur? Do you have recordings of the call? No. Do you have, the very next thing they would ask for is, do you have scripting or a procedure that governed how the employees were to respond to those questions? Were the employees put in a place where they would know how to answer those questions? Were they trained for it? And the answer was no across the board because, we were asked to roll these out almost instantaneously. So we would like people to start to take those lessons away and apply them to this program. If this is only going to go on for 3 months, at least at a bare minimum, start to outline a procedure that can govern some of the problems that we saw in 2011 and 2012 when the regulators started coming in. Brad, if you want to go to the next slide. Fair lending concerns. All right, so as the product rolls out, it's a commercial product, so some clients aren't really focused on fair lending risks, but they are there. If you're going to market this product in any way, this should be going through your fair lending officer or your compliance departments for a look at, who are you marketing to, how are you defining your mail drops, or who's crafting the language, or are you putting it just on your website? What you will start to see almost guaranteed, especially if these funds run out. Like if we exhaust this $349 million and there's people that, we're either late to the game or, we're sitting in application pipelines, you're going to start to see litigation alleging that, I didn't get to this because I'm in X protected class. You want to start protecting yourself around that now. That goes to how you're processing this product. The idea of first in, first out was mentioned in the FAQs and the CARES Act itself and the guidance that's been put out there, and you want to take that to heart. So when I'm saying first in, first out, you're not looking at, loan one comes in, so you have to wait till that goes through application, underwriting, whatever your collection of the steps, and then funding. Someone with a larger payroll is going to obviously, might have a more complicated ownership structure, creating, at least some BSA issues that you're going to have to run down. Once that loan's in processing, it's fine to start moving on to the next one. But what you don't want to see is, we have this loan that's $500,000, we want to focus on it and have this loan that's $10,000 that we can wait on, or that that person we don't believe is in such a crisis mode that they need these funds to keep a going concern. You can't allow people that are processing loans to think like that. If they're important customers of the bank, you don't want to treat them any differently. You want to have everything agnostic as to the processing of the loan. Are you expecting to take capacity? So we have some smaller banks that are looking at issues saying, we've dedicated X number of funds to fund these loans. And they're opening up the program and then finding that the demand is so high just for their existing customer base that they don't think they're going to be able to keep the program open that long. What you don't want to do in this situation is create an environment where you've let in way more applications that you're going to be able to process, and then have an application sitting in processing for an extended period of time, and then have to go back to the customer and say, we no longer have the funds to approve this loan. Then that customer is going to be forced to go to the next bank. Again, if those funds from Treasury are exhausted, you're going to create a lawsuit. There's going to be litigation risk there saying, you had me sitting there for days or 2 days or 3 days where I thought I was being processed, and you shut the window. So you should be thinking about, can I open the window and close the window at the same time? Can I take in just as many applications that or at least in real time track the loan amount so you can at least service the applications that are in there? Then when you're looking at that pool of applicants, do you have a waterfall? And are you applying that waterfall to the applicants that are in there? Are you doing existing customer versus new customer? Or any other metrics that you're going to apply to this portfolio through a waterfall, agnostic or neutral in their application? Are you timestamping the applications that come in? You want to make sure you have literally down to the hour, depending on the volume that you're coming in, or the minute, so you have some kind of metrics of who was served first if you're concerned about the amount of funds that you're going to be able to apply. And also exacerbating this is that borrowers, if they're reading the forms correctly, they shouldn't be applying to multiple institutions for multiple loans. So you do want to be cognizant of the fact that the funding capacity from Treasury might be exhausted given the demand that we've seen in only the first couple days. The next slide, Brad, please. Okay. I just had the opening paragraph or sentence up there is addressing findings of pattern and practice. If you haven't been down that road with a regulator, again, congratulations. You've sidestepped a not so fun experience. What you do want to do now is start thinking about how you can avoid that in the future. And the best way to combat a pattern and practice argument from a regulator is just building the ammunition when you roll product out. We talked about the marketing, we talked about the origination pieces, but you also want to start to think about how you're going to test this portfolio. It would be very smart to start to think about if you deploy regression testing, are you going to deploy regression testing, in the third, fourth quarter of this year to your normal operations? Are you going to deploy it against just this PPP population? Are you going to then combine them for a combined population? This will come and go very quickly, or it should. These 3 months should be behind us before you actually get a chance to even review any regression testing. It won't be long enough to go in there and tinker with your process, but you at least want to have the ability to create a narrative around it if you're starting to see statistical anomalies present themselves in the regression testing. What you want to avoid is having a regulator come in, find maybe disparate impact evidence in your mortgage department and start to expand that. Oh, let's look at the small business population, and then you're caught flat-footed as to how these loans were taken in and processed. Because again, it's being rolled out so quickly, you just want to start to outline the possible risks that could start to impact operations. Brad, if you want to go to the next.
Yeah, and one thing you mentioned earlier that you and I were talking about yesterday, which is interesting, is depending on how you read that application, it may imply that an individual has not applied to any other bank or financial institution for one of these loans when they initial that certification. And so if you're going to have issues with volume where you're not able to eat the volume of applications that you're receiving, you potentially are putting some of those customers in a pretty awkward jam where they're certifying then to other lenders that they will not receive one of these from anyone else. And so just be very cognizant that if it's going to take a long time to do underwriting, Because we've had a lot of our banks and credit unions and lenders putting up application portals, getting huge volumes, and there's some question about their ability to eat that amount of volume.
Another thing what we're seeing questions from banks is the Rego issues. So just from a high-level overview, so we've heard from multiple sources that Treasury stance here is that Rego exemption for U.S. guarantees applies, and Rego will be largely inapplicable to the process. I've had confirmation of verbal assurances from Treasury saying that loans to directors are okay. What we're having concerns about within Nelson Mullins is that if you look at the CARES Act language in 12010, businesses in which a lender or CDC or any officer, director, key employee, or close relative or holder of 20% or more of lender stock would be ineligible. So that kind of is basically a Rego control there, but in the CARES Act, even if Rego is inapplicable. But then if you look at the SBA's SOPs, it states this: the SBA will not guarantee a loan of the lender, its associates, partners, or close relatives as a direct or indirect financial or other interest in the applicant, or had such interest in the past 6 months. Because of that conflict, we're recommending that you just run the loans against your Rego insiders list and exclude any loans to insiders defined in your Rego policy. We're also recommending that a borrower certification be used at origination that where the borrower will certify that they do not have a close relative or that they are not a officer, director, or key employee of the lender. Again, it's the guidance we're getting is we're unable to reconcile it, so we're just erring on the side of caution here. Is it the last slide, Brad, or is there more?
And so we're basically to our point where we're going to open everything up for questions, but here's the bottom line, which is we're all trying to do what's right by way of the customers in light of a very, very challenging set of circumstances. And we know that all of the financial institutions we work with are going out trying to put in place these programs to try to help these impacted businesses. But don't lose sight of some of this basic blocking and tackling. Our whole In the Trenches series is designed to be, in essence, a Band-Aid. We're not telling you how to do this perfectly. We're telling you how to do this in a way that accomplishes the mission in a very short period of time. Before we open it up to questions, the last thing I'll say is these In the Trenches series are every Tuesday and Thursday. Thursday's 11 a.m. training session is going to be on consumer modifications, both for accounts as well as for loans, and what you can and can't do unilaterally, as well as what you can and can't do with the consent of that particular customer, member, borrower. If you need help registering for that, just reach out to your attorney contact at Nelson Mullins. We'll obviously be posting it on our COVID-19 resources page. There already is a chart dealing with loan modifications, and then also this presentation, the slides themselves, including those checklists, will be posted on the website, and then we're recording this presentation in case you need to forward it to any of your colleagues or anyone else who is helping with your PPP implementation. So as promised, we're going to stop right there. I'm going to unmute everyone. You're welcome to raise questions to the group if you want to speak up. If you'd prefer to do that anonymously, that's fine as well. You can simply type in the chat function a message to the presenters, and we can go from there. So give me 1 second. All right, everybody should now be unmuted. You can then click the microphone button within GoToMeeting or GoToWebinar. If you'd like to ask a particular question, feel free, or simply message it in to the team here. Craig, one of the questions it looks like that's come in is, what are your thoughts on how you can prioritize applications? I know you touched on that a second ago with the kind of issues with oversubscribed, but assuming we have the records, what are some ways that you're aware of in the past that we've worked to prioritize applications? And whether there's thresholds in terms of dollar caps, dollar minimums, things of that sort.
we would recommend that we keep it where you're going to try to think through what a protected class, or if there's going to be any overweighting of a protected class in a certain metric that you're excluding there. So like it may be unintentional, but you kind of want to keep it like, is an existing customer or non-existing customer? I would say that it's okay to weed out ceilings, like you don't want to go above $500,000 or whatever your high lending limit is. I would recommend that we don't take out loans that are on floors. Like I wouldn't say we're not going to go below 25,000 or below 10,000. I think you start to get out of balance there with your how the protected class may be represented in a population of those loans. Other than that, it should be based on intake. You can't do anything. You can't leave any of those decisions to the individuals processing. Don't have an exception report. Don't allow any individuals within the bank to say, "Oh, I got a call from XYZ, and they're in real need, so we have to get this one done. They're a great customer of the bank." If any of that were to come out and you did wind up, excluding certain applicants, it's not going to be easy to argue against it. Also, that's a reason why you want that waterfall. You want it committed to paper, so you can say, we were being as cognizant as possible. We wanted to, help the community's needs, and this was the best way we saw how to do that. So you can start even to put like a CRA narrative in that waterfall. And that way, if it's ever questioned, you have just that much more evidence to support your claims that, look, any disparate impact that took place within this population as it was being processed was unintentional.
Okay, one of the other questions that somebody emailed in is, what about adding to the documents beyond just the base SBA documents? And Craig, I guess we can both talk about this. One of the things we've been doing is recommending to our clients that they supplement the baseline set of documents that are mandated into the CARES Act. You've heard us mention the certification documents to, in essence, paper the file. We know that's become an issue with some of the core providers or some of the solutions that people are using to take these in. Again, it's kind of a risk issue, which is 3 to 6 months from now, make sure you've documented how you went through that decisioning process, meaning that there was no ability for your solution to do those customized documents or do additional presentations. If you do additional presentations beyond one of these kind of turnkey packages that we've been seeing, where one of the core providers or one of the e-signing solutions are going to help you present these documents. If you do end up supplementing that and you're going to exchange emails with the customer and have them mail in documents or sign it and email it back, remember all of these same rules apply with how you're going to authenticate it and then how you're going to maintain those records. So they all get logically associated with that underlying loan file or underwriting file. Because certainly at present, it doesn't look like E-Tran is going to have a vaulting system. It's just going to work like kind of standard SBA, where you'll register the loan through the E-Tran system. You'll be assigned an E-Tran tracking number, and that'll be associated with it. And then somewhat TBD how we're actually going to go about transmitting these and registering them up. And then in whatever system you have, make sure you have a process in place where you're going to register them into your core. Make sure you're, quote, boarding the documents appropriately, and especially if you're going to do paper processes or non-automated processes, make sure you have something in place where you can do that boarding so that you can make sure it's properly accruing interest and what have you, as well as to the extent you use your core system to provide regulated reports of your lending activity. You want to make sure they're boarded, not just living in this kind of odd cloud of PPP loans.
The only thing I would add to that, Brad, is if you're going to add documentation to the SBA recommended docs, just be hyper sensitive to the fact that we don't want to add anything in there that would impede a borrower's ability to get to the funds. Like if the document that we're adding is for the bank's protection, having the borrower recertify something, great. You just don't want to put like any extra underwriting standards that are in there, or thresholds that a consumer would have to reach. Just be hyper aware of that. Like you don't want to make the bar higher than the SBA has it.
Great point, Craig. Other questions from the group here?
Brad and Craig. This is Jeremy Groom with First Reliance Bank.
Hey, Jeremy, how are you?
Good. On the fair lending points, so I'm just going to throw out what we have been doing up to this point. Last week we put an inquiry form on our website allowing businesses to just communicate their interest to us. And last I heard, I mean, we got over 300 inquiries, and so that's a mix of existing and non-existing customers. But we at this point have decided to earmark about 50 or 60 of those existing customers that we just want to go ahead and help right away. That's based on a couple of things: tenure of relationship, and then also coupled with just the dollar, if you will, dollar amount of deposit and or loan relationships with that customer. And then everybody else, we're working with a third party to provide as a referral source. I guess just thinking through that, I mean, all the other things that you and Craig have mentioned, we're considering, but would you mind just kind of shooting at that? Tell me some other things we need to consider.
Craig, you want to take that one?
Sure. So you mean so let me if I understand it correctly, you put a call out on your website, you had some like initial inquiries, and now you want to not prioritize, but within that group that there's valued customers that you'd like to help, correct?
That's right.
So if there's a limited amount of space, what I would do is just, off the top of my head, I would recommend that you open up whatever loan portal you have. I would tell those customers, we have this opening up. Here's the process, and just refer them to the process that everyone will have. You can recommend that you only have limited funds, so apply as quickly as possible, but you don't want to give them like early access. Like, have them apply through the same channel that the general population of your borrowing population is going to apply to. Create a waterfall that or create a program that says you're only going to do existing customers right off the bat, so you have limited funds. So it'll right off the bat you can not deny, but you can exclude any non-customers that come in through that same channel. What I wouldn't want to see you do is have those in process when you open up the program to the general borrowing population, and then have your allocated funds exhausted. Do I think there's a ton of risk there? Not really, but why even deal with it if you can do it in a manner where call the individuals depending on how big it is, or I would also call them. I wouldn't write them or email them, and say, look, we're opening it on Wednesday at 11 a.m. This is what you'll need. I suggest you do it as soon as possible. Does that make sense?
It does. Thank you.
Other questions from the group? All right. Well, hearing none, thanks so much, everybody. Again, if you need registration information for Thursdays in the Trenches, it'll be dealing with consumer account and loan modifications. Hope to see you then, or hear you then. We'll stop the recording now of the session, or actually, I guess it will stop before the questions. And